Very good afternoon, everyone. Charles here, FRGNT Daily Chart Analysis. The time, just approaching 10 minutes past 2 here in Milan, local time, Monday the 13th of April, 2026. Very good afternoon to you all. This video, it's not going to be chart analysis in terms of pre-New York, where is the market going. It's more so a couple of thoughts that I've had. I have been meaning to make this video, but I wanted to have the evidence before I actually created the video. Now, or the content. Well, it's a bit of a self-critique, which as a transparent trader, a transparent type of individual, I'm happy to share, just in case anyone else is in fact going through much of the same. Now, it's not anything I would say that I have done incorrectly. It is recognition of the market of which is providing opportunities. Now, something that I teach, something that I go on and on about is have your setup there, await your setup. Once it aligns, have your entry criteria nailed, enter the position. Now, what I have found that I had been doing, even let's say mid quarter one into, of course, the beginning stage of quarter two, is having my initial better areas on the chart. And what I'll do is let's make a big screen on something and let's go for it. Let's create the scenario. So, of course, we can see here price is in a downtrend. That's very easy to see. So, of course, my better areas in terms of a short position are going to want to come from these areas. If you play the game with me. Now, of course, as price starts to make some moves towards the opposite direction, the temptation is to want to immediately look for a position towards the upside. And that's all fine to say and fine to do, providing you're supported with, let's say, higher time frame confluence in the opposite direction. So you're within a 4-hour order block. Perhaps you're within a daily order block as well, leading to allow you to the left. If I create that scenario also, if we say price at some stage had created a large push to the upside, come back down, etc. And now we're simply returning to, let's say, that area, like that. So you've got very good reason to want to be looking to take a long position from here, but the overall trend and market sentiment is bearish. So what I've found that I have been doing of late, and again, just to emphasize, it's not incorrect, but I have recognized a slight change in trading pattern. And it's not as if I've been worse off by making that trade, but I feel like as a trader, I have been more active on the charts. And that doesn't necessarily mean better results. In fact, quite the contrary, in terms of the fact that I found myself taking an incredible amount of break-even trades. And that's not something that should be frowned upon. Break-even trades, they're great trades. But taking a break-even position from your first or your best area, I'd say that gives a green light and some thumbs up. But taking a break-even trade from an area of which you know isn't the best area, I believe that personally, that is risk not really warranted. So it's just me being a little bit self-critical of my own performance over the last couple of months. Now, here's the scenario. Of course, we can see that price is in that downtrend with broken structure points continuously on the way down. That's clear to see. And just to paint the picture, I believe an illustration always paints the best type of picture. So there we have it. In the downtrend, I should predominantly be looking for sell positions. Now, what I've found that I've been doing is using the DXY as confluence for good example. So let's say this is the DXY and we're expecting the DXY to now, let's say, push up from this area. Then in contrast, I'd be looking for GBP US dollar, let's say, for example, to create me a short position from the highs. Now, if I focus on this again, looking at the structure points on the on let's say GBP US dollar, looking for the shorts, the clear structure point in the market is evidently here in terms of basic price action and structure, we could understand that the most recent high was created from here, and we'll simply call that the higher low, and we'll simply call that a structure point. In contrast, on the DXY, we have this area here that created the most recent low, and we'll call that the lower high. Very, very basics, the very basic fundamentals of trading. So therefore, until this area is completely broken, we are to remain bullish let's say here in this scenario in GU, before looking for a short position. We are needing to see that structure break. However, what I've been doing recently, and again, it's not wrong, it's just understanding the market phase, which I have been doing correctly, and understand that I need to manage my position more aggressively, is this. I've been understanding that price is in a position where I could well anticipate a turnaround in the market. We have that higher time frame order block where price is in, supported, let's say, even let's paint the real scenario, supported by some EMAs that is now coming down, holding price to the downside. So I have that incentive to short. Now, again, to repeat for the millionth time, what I have been doing is looking for those lower time frame breaks of structure, i.e., look at this point here. We haven't made a high from here, so this is most certainly not a higher low. However, what this is on the lower time frame is a very intricate break of structure. So what I would be looking to understand or looking to do is say, well, right, I can understand based on the lower time, i.e. 1 minute break of structure, here is the imbalance of where price is looking to come back down towards, and the risk is that once price hits that area, we could then see price then make that higher high or push higher into, let's say, my break-even position. And this is exactly what I've recognized over a good sample size of my positions, that once price, let me get rid of that for a moment. Once price is up in and around these areas, and I found a 1 minute break of structure or a bearish engulfing candle, let's say on the 1 minute time frame, what I've been doing is entering the trade and ensuring that I am break even by this point. Now again, that is not incorrect. It's smart management of my capital. However, what I'm then finding will happen is one of two things. I'll be stopped out break even, which again becomes quite frustrating, which could then lead to some psychological behaviors in the market that we're all trying to avoid. However, what's then happening is price is providing me with the correct setup, i.e. we have the break of structure. Then only for price to return, and that's when the true setup is now aligned. Here is where I should be looking for my lower time frame breaks of structure as a result of this structure phase broken in the market. Typically, what you'll see as well on the DXY is what I've been using as that confluence. Before seeing this area on the DXY broken, I will be, of course, looking at that area, but also here. So what I'll see is, for example, on that 1 minute time frame, a bullish engulfing candle, which then leaves me with a lower time frame order block to manipulate. Once I'm seeing that, I'm then having that confluence then to take the short position on GU, expecting that DXY is now going to push bullish. And what's then happening is I'm having to manage my position based on the DXY as the DXY comes into the imbalance on that lower time frame because of the risk of price doing that, the inverse of what we just explained on GU. Again, so the better position of what I have been very successful using, that's my strategy. However, for no unbeknown reason to myself, I've no idea quite clearly why I have deviated. The only thing that I can put it down to is the fundamentals in the market leading me to believe as a trader that I must now enter the market sooner rather than later, move my position break even sooner rather than later. But what I found is that simply is a little bit of an excuse to actually just enter the market with the expectation that price could now rocket in my favor. So again, it's a very transparent approach that I'm happy to share for you all. And then just to finish up this illustration, of course, we can now see, based on my description on GU, the better perspective to take. And the perspective, if you go through my chart analysis, the perspective that I always take. Wait for structure to be broken, at least that structure point that created the most recent low. Now you have at least a good reason to anticipate price to want to at least reach that equal high of which it's created. The order block that we're looking to manipulate has proven itself that it does indeed have the liquidity to push price higher. And then once you get that, it is here where I should be looking for those intricate entry techniques, because here is where I should be aggressive. The setup is now confirmed. All I need to do is use my entry criteria to actually get in the market. Again, just to emphasize that, I've been doing, or essentially looking for my entry criteria before the full setup is developed. Now, it's not as if I have been any worse off by doing that, but again, just to step slightly backwards to the start of the topic, my trade volume has gone up. So knowing that I am an active trader, I am a day trader. However, I've been very successful with quite a limited trade volume. Now, to see that my trade volume has gone up, but my rewards haven't gone up exponentially as the amount of trades have gone up, means to me that I don't actually have to be doing that. Therefore, I will revert back to this method of trading, of which, as I say, I've no real clear reason to why the diversion has taken place, but it's just something that I've recognized. As last night I went through 135 of my positions, I shared it with my little close community, and I figured, well, why not share that with the wider community, because I potentially am not the only one going through that. Recognizing or having that recognition that, well, why am I taking more break-even trades, but actually my rewards haven't increased as a result of more exposure to the market? And that just brings me nicely onto the casino analogy. It's not that we are, or I am, gambling by doing this, but without having that confirmation of the clear setup developing, I am having too much expectation that price is going to move and continue moving and not pulling back. Now, the best the best decisions to be made are when price actually does create that move. So you no longer have to be the first in the market. And I've never intended to be the first to trade. I would always much prefer see price go in the direction that I'm looking to trade in, have those breaks of structures on the 15-minute time frame, perhaps even wait for a candle to close in a certain direction under a 50 EMA. And to paint that picture, let's say, for example, this is not where the EMA is anymore. Let's say then I've seen my setup, however, against my setup is, let's say, the 4-hour 50 EMA there, meaning that it's unfortunate that my setup has occurred. Well, it's fortunate that the setup has occurred, but it's unfortunate that the 4-hour 50 EMA is actually supporting price to the upside. So more often than not, what I'd be then waiting to do is actually just wait for a bearish candle closure on the 4-hour time frame below that 4-hour 50 EMA. With that said, what that will then be is, I definitely won't be the first in. I probably won't even be the second in that trade. But what it would mean is price would start to have already developed, meaning that I'm no longer in this anticipation phase of the market with the expectation that price is going to push in a direction and actually continue pushing and not pull back. We understand how price moves. Price makes lows and lower highs. So therefore, once I do then get that bearish 4-hour candle closure below a 4-hour 50 EMA, the only thing that I have to wait and have the expectation of is for price to move in the way that it's always moved. And if it doesn't move in the way that it always moves, it's simply a position that wasn't for me. So then, therefore, once that 4-hour candle closes like so, it already drawn the fact that price would have developed I'll simply be waiting for a price to return back up to those areas for me to join the rest of the trade. So I hope that was insightful. Just a quick 15-minute video, just sharing my thoughts of my own trading analysis of my results over the past couple of months. And again, if you are a trader that does this, you're certainly not wrong. I wasn't wrong in doing so, but it's just something that I've recognized. My trade volume has increased, but my rewards haven't. My losses also haven't, because I'm having to go break even incredibly aggressively and sooner rather than later, based on the imbalance in the opposite direction. So it's been very successful in the fact that I haven't lost any more money than I would have if I was trading my standard method. But actually, I feel a bit tired. My method of trading has never been that aggressive, and doing that over all of these pairs that you see that I'm actively trading, of course not at the same time, but let's say I see a lovely setup on EU and GU, and I also see a nice setup on US dollar CAD in the opposite direction, then as you can see, this becomes a bit of hard work if I'm doing this and not actually waiting for that break of structure first and foremost on that 15-minute time frame. So just one from me to you. Please don't take any offense if this is your method of trading. It's just an observation that I've had on my own results. And until next time, everyone, take care. Good luck in your trading journey. And let's see what quarter two has in store for us. All the very best. Cheers.